Good afternoon. This is Mike Mendelson, the Bear Market Investor, the market update for April 11, 2011. We're here looking at the S&P 500 stock index, and we're going to be looking at the Volatility Index after this. Now, we're looking at the monthly time frame right now, and if you have not done so, please do watch the prior video. I realized one of the viewers said it was maybe a little bit on the long side, and I apologize for that. I didn't have as much opportunity to edit some of the extra footage out that was probably not required. However, I do hope it's worth a view because I do go into both this chart here in the long term on the S&P 500 as well as the Volatility Index, and I have done work on both of these charts, and I want to show you this. I think it's interesting if nothing else. Now we're looking at this in arithmetic scaling in the monthly time frame right now, going all the way back into the mid to late 90s. And we have two cyan trend lines here at the top. This blue one can be discussed in the prior video if you watch that, but I'm going to concentrate on these two right now. This top one right here is what was originally drawn on my chart. This is the most probable top, I believe, for the S&P 500 if indeed we are tracing out a bear market rally. However, there has been some hesitation in the S&P 500 recently, in that from the February 18 high, we had what appears to be a three-wave decline. We'll get into that more in the daily chart in just a moment, but the three-wave decline suggests that it is a correction to the upward trend that started here in March of 2009. And if that is the case, then we should expect a five-wave rise from the bottom of the sell-off from the February 18th peak. However, it looks like we may have already had five waves. Now, one could consider it possible that we had a truncated fifth wave, and that we are beginning the decline already. And that's why I have drawn this second or lower trend line right here. So I'm considering these two cyan trend lines right here, areas of resistance, to be the resistance zone. I have also added, in addition to what our target had been here at the 78.6% retracement from the decline up here in 2007 to the March 2009 lows, I've added the 75% retracement. Now, Fibonacci retracements have many different ways of representing themselves. The more common ones that you're going to see are 38.2%, 61.8%, and 78.6%. 50% rise, which is half, sometimes occurs as far as a retracement is concerned, and you can expect that at such levels you might see or encounter some resistance. The same thing is true of a 75% retracement, which would be 3/4. And why I think this is quite fascinating is because when I have these two lines right here, these two cyan trend lines, and where they intersect directly above where we are here is at the 75% retracement, almost exactly, and the 78.6% retracement, almost exactly. Now we'll go into the daily time frame here in just a moment. I do want to show you this though here in the long, big picture, because it's very, very important in that if we did have a truncated fifth wave, this could help explain why that we have a lot of overhead resistance. Now, I still think there's a greater probability that we may see yet a little selling, but I think the probability is still on the side of the bulls in the very, very short term in order to meet that 78.6% retracement and push in to this upper cyan trend line right here. You can see two of them, I hope, even in this resolution. Now let's go ahead and take a look at some of our other indicators here. Now, we could say that this is starting to encounter some resistance here on the MACD as far as trending is concerned. And we are beginning to roll over on the MACD histogram. Now, histograms can sometimes form divergences. I believe in the case here we do have a divergence. However, that doesn't mean it won't continue to diverge, or that we're necessarily done with the rise. It's just something to keep an eye on. We also saw in this last leg here, as far as the monthly time frame is concerned, we are not in overbought territory here on the RSI. There is a fair amount of weakness. In other words, when I say weakness, not that the market is extremely weak here in the monthly time frame, but we aren't seeing the strength that we had back in here. Okay? That's a very, very important thing, and suggests that this market is probably pretty well ready to begin declining. We're also seeing the stochastic here beginning to roll over. Now let's go ahead and jump into the daily time frame in the S&P 500. Now we're looking at the daily time frame in arithmetic scaling as well. And what I want to draw your attention to, and what was very interesting to me when I had drawn that bottom cyan trend line right here of the larger resistance zone that I was describing, is that is exactly where we hit on February 18 and began our decline after that. Now this decline appears to be three waves. A three-wave decline is a correction to the trend. In this particular case here in the daily time frame, this means we're correcting the uptrend, suggesting that we should see further upside. Now we have a tremendous amount of resistance up here. Not only did we hit this lower cyan trend line right here of this larger resistance zone, but we also pushed into that 75% or 3/4 retracement level. From there, one could suggest, from an Elliott wave perspective, that we did in fact have a 5-wave push up. Now, under most circumstances, if this is to be construed as wave 4 of C in an ABC correction, we should see a 5-wave push up that exceeds this prior peak. However, there are rare circumstances where you can in fact have a truncated wave, a truncated 5th wave in this case. You can also have truncated C waves, but there could be other explanations for those as well. Now, in looking at this in particular here, what I find interesting is that we have come right up into that resistance zone boundary right there, and we have rejected off of it, failing to move above the prior peak, even though this appears to me to be a 3-wave correction. So we could actually have that 5th wave truncation right here, and that we will see no further upside. However, we have not really started to decline in any serious manner yet. Even though things look like they're ready for that to occur here, as I was showing you on the monthly time frame, we're also seeing the MACD histogram continue to slope down. Hopefully that'll push past the 0 boundary there. We're seeing the MACD curl over. We're seeing the stochastic attempt to come out of overbought territory, however it has not yet done so. And we're certainly not seeing as much strength right now as we were at this prior peak right here on the RSI, with the top there being at 88.83. Now if we push into the 90s, that's showing quite a bit of strength, but we're showing much more strength back here than we're ever showing right here. Okay, so certainly conditions with our indicators look like they are agreeing with the possibility that we may have in fact already topped. However, we have to give the market a little bit more opportunity to show us what it's going to do. Is it going to push beyond this? I think it could. We could have something similar to what transpired here. And if you did not understand what this is right here, please do watch the prior video. This also happened to be exactly at that 61.8% retracement. Interesting how all of these tend to intersect, isn't it? From there, we got rejected, came back down. Found a little bit of support there and attempted to push through it. Found some resistance, finally did it, and moved on further up. Now, we have a tremendous amount of resistance up here. This is huge resistance. I expect that we may push into this resistance zone. However, again, as I noted, we could have actually already topped. So we'll just have to wait and see what the market gives us here. If we did indeed have a 5-wave push, either we had the top of a first wave right here, or we're carving out some sort of fourth wave in this fifth wave right here, and that we'll see a fifth wave push into this. And this were the top of a first wave right here. We could see a decline, and then a rally, and perhaps a decline, and maybe an ending diagonal formation of some sort. I don't know, a lot of different possibilities here. Or we could have seen a completed 5-wave push right there, and this is a truncation. All different possibilities. Or this could even be a 5-wave decline right here. I just don't think so. I think this is pretty firm footing right here to call this a 3-wave decline, suggesting that this should be inevitably a 5-wave push. Whether or not we completed that remains to be seen. So there we have it, upper boundary here, round number resistance, 78.6% retracement. All this stuff is directly overhead, even if we push through this. Now, some of the markets have been doing odd things. Some of them have approached or even exceeded their 2007 peaks. So bear markets can unravel in many different ways. You can have some markets continue higher while others don't. They don't all trend together in exactly the same way, meaning the NASDAQ, after the dot-com bubble, never even got anywhere near that peak. However, the S&P 500 did back in 2007, as you could see. Dow Jones Industrials as well gone beyond that. But those two major indexes here, the S&P 500 and the Dow Jones Industrials, are in and around the same area of retracement here. Now the Dow Jones Industrials did push above this last peak right here. Now the S&P 500 has not yet done so. However, the odds are still, because of that happening in these two senior indexes, that we may yet see that. So let's wait and see what happens. Now let's take a look at the Volatility Index. I've probably said enough, and all that needs to be said on the S&P 500 right now. Okay, CBOE, Market Volatility Index, otherwise known as the VIX. We're looking at it right now in the weekly time frame. If you're not familiar with the VIX essentially is the fear gauge for the stock market. Shows us when there's extreme panic and extreme complacency. It doesn't always coincide with true tops and true bottoms in the stock market. In other words, in 2009, everybody that follows the stock market knows that the S&P 500 made a low in March of 2009, along with many other U.S. indexes. However, the strongest area of decline in the S&P 500 was in 2008. That also happened to be where the peak was put in here in the Volatility Index. So we saw divergence there in the Volatility Index. We saw less extremes in the Volatility Index into 2009, also suggesting that the market, even though making a new low, wasn't quite as panicked. More or less, the bulls had capitulated. They had decided that there was no upside potential in the stock market at all. And that's when we saw the stock market begin to rise in 2009. But that spike back in 2008 shows just how panicked the market was. Likewise, when we have extreme levels of complacency, we can see tops form around those areas. But we did not have a top, a long-term top, back in 2010. But we did have a top. We had a top in April of 2010, followed by a pretty strong sell-off. That allowed us to form this upper resistance line right here. I also showed you in the last video the relationship between this declining area of resistance and the Fibonacci fan. This is another unique element that I'm able to bring to you to show you the unique characteristics of the market and why nothing is coincidental. It is not coincidental that the 78.6% on the Fibonacci fan exactly matches this declining resistance. It is not coincidental what I'm about to show you either. And that is, I have identified cyclical time periods within the Volatility Index, and I'm going to be sharing that with you right now. Now, visually you can see two declining periods so far within the Volatility Index. From the breakout that we had in volatility back in 2008 until the peak there, and then the subsequent decline, we have one time period which may be divided into two periods itself. This was an initial wedge pattern here. We saw an attempted breakout right there, but that breakout failed. It failed in that it did not lead to a huge surge in volatility, but it led to a sideways down movement in the Volatility Index until we came to this horizontal level of support. From there, after that time period had ended, we entered into the next time period. The next time period looks much like this time period, except exactly half as big. I have subdivided this into two. That's why you get a couple of these lines here that are right next to each other. I couldn't make it any more exact than that. It's just the way it is. But this time period right here is exactly half of this time period, or equal to this time period. Now, what is extremely fascinating here is we had that wedge pattern here as well. However, the wedge pattern that allowed me to create the Fibonacci fan was right here. This wedge pattern is the 38.2% on the Fibonacci fan. Exactly in the middle of this time period, we have the same occurrence as we had here. We moved sideways, down. We moved sideways, down, into the next time period. Now, if the cycle continues to subdivide like it has been, could potentially lead us in as far as July of this year, the middle of July. The middle of this time period happens to be the first week in May. Now, I don't know that the cycle is still active, but what I can tell you is that so far, as I've noted in the past, we have not broken through the 78.6% on the Fibonacci fin or this declining area of resistance. We penetrated it, and the very next day, keep in mind we're looking at the weekly chart, the very next day, after we pushed through it and closed above it, we opened below it, and hence the false breakout. So, until we get a real breakout of this, the larger bear market is not here yet. At least it isn't in the sense that we're expecting a major sell-off to occur right here and right now. We may see the beginnings of it, but I don't believe we're going to see anything like what we saw here or here occurred just yet. We need to see this break. Okay? And as you can see, with the subdivisions of these time periods, we have this period as well, as I was just noting, with the middle of that being the first week in May. So if the market does continue to hold up, I expect perhaps the same thing to occur here, or to occur here as occurred here and here, in that we might see a little bit of a surge in volatility and then we'll move sideways down, completing the final perhaps subdivisions in the S&P 500 if the cycle is still active. So I'm hoping it doesn't last up until July. Cycles come and they go. This cycle was here, and I'm showing you exactly how it worked. I'm showing you exactly why it's relevant, because right after this time period ended, we did see that surge in volatility. However, what's slightly different here, even though we are coming into or approaching the middle of April, we're not quite to May, is if we don't see a surge in volatility, we're pretty darn well close to this horizontal support line right here. And each of these cases, while we were closer to it, we weren't quite as close as we are now, even in relationship to the rise that occurred before it. So we'll have to wait and see. I mean, I am expecting that the market probably is not quite finished yet. And we may see some things that I find interesting and did not necessarily anticipate, but more or less hold true to what I was telling you all along occur in the S&P 500, in that we could actually hold up in through July. I've noted that in the past it may actually do that. But I'm not sure how it'll get there, because I don't see us having a whole lot of additional room to the upside to go. So that's why I'm eyeballing that May time period as well. So let's wait and see what happens. I mean, regardless of what happens, I can see whether, we're breaking to the upside real quick here, or we wait until May, or we wait until July. The end is in sight. We have some pretty credible reasons, however, to believe still that the market may go just a little bit higher, as I've shown you in the S&P 500. However, it doesn't have to. As I've noted, cycles can come and go. So let's wait to see how this transpires in the days and weeks ahead. But note that the first week in May is the middle, as you can see here, of this time period right here. And that's when we could potentially expect that the market may break out, if it has not already done so already, in that the market will start selling off. So if you have not done so, please do go ahead and subscribe to the YouTube channel. rate the video if you would. I apologize for making this yet a little bit longer than I wanted, but I hope that you found it informative. Do give a thumbs up if you would, comment on it. So have a great night, and I will speak at you guys later.